Banks make money in two different ways. One of them is called turn. And they want to turn that same money several times a year. We've heard somewhere between 6 and 8 times a year. And what that means is they borrow you money, and then they take that money, they fund your loan, and they're going to turn right back around. They sell it off to Fannie Mae or Freddie Mac or HUD or to some investor, and they take that same block of money and then they lend it to another borrower, and they do that repetitive times. They get the fees off of the front end. They also get a service release premium that sometimes they can keep, and so that's one of the ways that they make money. The second way that they make money is very simple. Banks borrow money from, let's just say, the Fed. And right now, if they're borrowing that, this is not a true term or a true percentage amount, but let's say they're borrowing that amount at 1%. They're borrowing from the Fed for 1%. We call that an index. That's the rate at which they borrow from the lending institution. And then they turn around and they lend that money at 4%. Well, the difference between the 1% and the 4% is what we call their margin. So the margin then is 3%. Now, some banks may have a little bit fatter margin for one reason or another. Higher overhead, the type of product that they search for or lend on. There could be a whole host of different factors for why they have bigger margins, but that's why you can see from one lending institution to another differences in how much that interest costs based off of what their model is. So that's one of the reasons. The second reason that you sometimes see is they have different pricing structures, meaning there could be, so they may charge an origination point up front, which will usually broadcast a little bit lower interest rate. Or there could be a whole host of other variables that are tied into that. But most of the case, it has to do with their margin, and it also has to do with how their fee structure is when it comes to offering that particular loan.